Yeah, again, my name is Brian Basinger. I am a CPA. I started out working in industry and I eventually broke out and went and started my own firm and was doing taxes probably the same way that most CPAs do them, which is just doing everything retroactively, and kind of had a series of epiphanies in working with clients and realizing that um, this needed to be a proactive this needed to be a proactive engagement, that really the tax return is the end of the process, not the process itself. So I'm a business owner myself. I love entrepreneurship. I love the process that it kind of forces us into to get better and the opportunities that are there with it. And really, I love working with taxes because it's a very like tangible kind of puzzle to be able to put together. But even I understand that taxes are not the goal. Uh, Taxes, we don't get into business and we don't um, seek tax savings in and of themselves. The goal really is wealth creation. And what we are hoping to do ultimately with wealth is create the scenario in which we have the freedom over our money and our time, and we have control over our assets and what happens with them. That, in my view, is what we're aiming at with wealth. So, saving taxes is a means to that end, because if we can take a significant amount of money every single year that would otherwise just be flushed down the drain and apply it towards investments and towards wealth creation, it doesn't take very long for that to add up to a significant amount of financial freedom. So let's see, let's jump ahead here. So taxes are um, kind of I think of business and I think of finances in general kind of like a bucket, and we've got money that comes in on the top of the bucket, and we've got a whole bunch of things that come out of the bottom. And taxes are probably the most offensive of those things because it's such a huge chunk of our profits, and it um, has no benefit to us. So, well, maybe not no benefit. We get to take advantage of the country, but anyway, it's not something that we take a lot of joy in typically. So there is kind of a secret that's often overlooked when it comes to tax planning, and that is that Congress, the lawmakers, actually love business owners and investors. And we know that they love us because the tax code is essentially a whole guide of incentives. Incentives for certain business activities, for certain investment activities that Congress wants us to do because they raise the economic tide that lifts all boats. And so they're trying to encourage those activities and they provide these incentives. And uh, and we as business owners and investors get the opportunity to take advantage of those incentives. So that's what we're going to talk about today. Um, why perhaps you might not be feeling those incentives, or if you're wondering kind of what else is out there. We don't, in the time we have time to get into everything and all the specifics, but I want to kind of give you a framework to understand how we think about tax savings on behalf of our clients, and hopefully to help you um, see those the same way. I'm just realizing something here. Hang on. Um, I am missing some images. So let me see here. See if I can make this fly. So I have to jump around, but that'll make it work. All right. So that framework is essentially um, effective tax strategy is built on proactive planning. So the first thing we need to understand is the strategic awareness of like, if we don't change anything, what is going to happen? Um, what's going to happen? What's your tax return going to look like? I'd hope that everyone watching, if you're doing planning, that you understand what your tax return is going to look like next year when you file, in April or whenever you get, whenever you do file. that is step one in being able to do tax planning, because in order to change our taxes, we have to change what actually happens and the set of circumstances that we're reporting on those taxes. And so that is the foundation. And we really cannot do tax planning without doing proactive strategy. And that starts with just understanding what's coming. And then in addition to understanding what's coming, we need to understand what um, what long and short term goals are. So things like, are you planning on buying a new house next year, or a vacation property, or are you planning on selling the business? And the further ahead that we can anticipate those things, the more we can arrange the circumstances to be able to take advantage of the incentives that are in the tax code. And when this is done well, uh, essentially, you know what your tax return or what your taxes would be if you don't do anything. And then you're able to know, okay, now if I do A, B, and C, how much do each of these ultimately affect how much I'm paying in taxes? So again, that's the foundation, is the proactive piece. And then the first column, basically the first sort of pillar of tax strategy that we place on top of that, is entity structures. The key with entity structures is to understand that not all income is created equal. The same dollar of income can be taxed differently depending on how it flows through corporations. And I will give you a couple of examples, of maybe some of the most common things that we see when it comes to entity structures. The first one has to do with having multiple S corporations, or having S corporations that are not optimized. So every S corporation, I'm sort of approaching this from like an intermediate standpoint here, but just to kind of go to maybe the basic level of entity structure strategy, we use S corps to avoid or to sidestep a good chunk of self-employment tax, but the FICA tax, the Social Security, Medicare, Medicaid, because that is kind of the first hurdle that gets entrepreneurs when they're just starting to make money. The first thing they run into if they're not doing tax planning is they made $100,000, and all of a sudden they owe 15,000 just in self-employment tax, not even counting income tax yet. And so the S corp helps avoid that. But if we have multiple S corps, what ends up happening is that we have to pay multiple owners compensation. So the trade-off to that FICA tax savings is that we have to pay the owner a reasonable salary. And having multiple S corporations, or setting that salary too high, being too conservative, too cautious when it comes to determining what that reasonable salary is, can end up being very expensive, because not only are you getting 15% siphoned off on every single, Jeff, I see your question. I'll answer it here in just a second. But not only do we get 15% siphoned off on the FICA taxes, but we also lose out on the QBI, or qualified business income deduction. And so we like a dollar of income running through an S corp as profit is really generally only 80% taxable. So only 80 cents of that dollar are taxable, because business income through pass-through entities is incentivized with this qualified small business income category. So we get a 20% deduction on it. Wages are 100% taxable, and we have that 15% FICA tax that gets added on as well. So it's way more often than I guess I would think. Do I see someone who's who's making, let's say, $500,000 in total income that shows up on their tax return, and they're paying themselves a wage of 250,000. So half of that is not eligible for this qualified business income deduction. They're losing out on $50,000 of potential deductions, and they're paying FICA taxes on all of that. And then, Jeff, I'll just jump in and answer your question real quick. The PTSP stands for partnership. So what this is illustrating is, generally speaking, the structure that we want to set up, and this is not 100% of the time, but generally speaking, we want to have kind of one S corporation that stands as 100% owned by you, and you would be the only owner of that. And if you are involved in a business with a partnership, we would generally have that partnership be owned by your S corp rather than operating as an S corp directly. And there are a number of reasons for that. But the probably two primary are: one, it allows for each partner to be able to maximize their own deductions within their S corp without having to worry about making things equal within an S corp. S corps require that distributions be equal to ownership shares, and so it gets really tricky to try and balance things out. If one partner wants to drive a Maserati and the other one wants to drive a Camry, how do you make that equitable? And oftentimes the only way to make it equitable is to compensate through W-2 wages, through owner's compensation. And that's, as I was just talking about, that's not an effective way to have that compensation flow. The second reason is to avoid multiple S corps. So if you're involved in multiple businesses, having a single S corp and then having that S corp own the other operating entities allows you to only pay yourself one single wage and not have to pay a wage from each and every business that operates as an S corp. And then to kind of segue here into the third point, the third reason is oftentimes as we get more involved, so as income overall goes up, generally speaking, well, I won't muddy the waters with that, but as income goes up, there are many times when it makes sense to involve a C corporation. And the obvious downside that most people know about a C corporation is that it pays a lower tax rate, so a flat 21% tax, but then as profits are distributed, they get taxed again. And so there is a double tax, or at least potentially a double tax. But there are enormous benefits to C corporations also. And this is why it's not kind of a one size fits all strategy. But there are a couple of reasons generally to use a C corp. One could be that you want to offset losses. You have income that you can't offset against passive losses that maybe you have, and they're kind of siloed off. Maybe you have real estate losses that you can't take against ordinary income. A C corp does not have those different types of income and can net those losses against each other. The other reason for C corps is to essentially act as holding companies, where they can hold profit and keep it off of your return and have it taxed at 21%, still have it be available to you through shareholder loans, and effectively roll up into generally a trust, but never be taxable income that's going to be distributed. So on $100,000 of taxable income, rather than pay half of it to the IRS, you can pay 21,000. Half of it in taxes. A lot of times you can get away with paying something like 21%, that flat tax rate, and then you have 80,000 left instead of 50,000 left. It's just within this C corporation. But when you want to pull money from that C corporation, a lot of times the most effective way to do it is to have the C corp pay into an S corporation, like for, say, management fees, and then filter that income through an LLC operating as an S corp rather than take it directly as dividends. Okay, and then on the passive side, usually we would have something like a family management company that operates either as a sole proprietorship or as a partnership between spouses. And we want to generally isolate off passive activities through this family management company from the ordinary active income on that will filter generally through an S corp. Okay. that's kind of a high overview of entity structures. The main point here is just to question it. It's just to say, is the income that's flowing to me in the most effective way possible? Or am I having this, this dollar of income be taxed at a higher percentage than it needs to be, um, because because I could run it through a different type of entity and have it be taxed at a lower rate. Okay, next is the second pillar is deductions and credits. And I'm going to kind of keep this high level because there are way too many potential deductions and credits to get into. So the principle here, the magic words to remember when it comes to deductions specifically, is ordinary and necessary. That is the criteria that we need to meet in order to deduct an expense. And generally speaking, we can meet those criteria if A, we want to badly enough, and therefore we're motivated to, again, arrange the circumstances in a way that would allow a certain expense to be considered ordinary and necessary. And B, if we're doing it, again, proactively, so that we have enough time to actually set things up to where it is ordinary and necessary. What we can't do is after the fact wish that something had been ordinary and necessary and just throw it in. But what we're trying to do with deductions is to take as many things as you are spending money on and to shift them from after-tax expenses to pre-tax expenses. And again, in order to do that, they've got to be ordinary and necessary in the operation of a business. So I hear all the time from entrepreneurs that I'm talking to that, okay, I asked my CPA if I could deduct this, and they said I couldn't. I asked my CPA about that, and they said no, it's not good. And so the key point is to ask how you can deduct the thing you want to deduct, not if you can deduct it, because there's almost always a way. Again, we may not be like the incentive for that deduction might not be big enough to justify the inconvenience or the hassle of setting it up in a way that makes it ordinary and necessary, but there is almost always a way. An example I like to share is of a client we had who wanted to buy a tractor, like one of those Kubota tractors, and he's a dentist, and he, it's hard to justify a tractor as ordinary and necessary for a dentist. It's kind of a blunt tool for dental work, but he owned his building. And so what he did is he set the building up in a different LLC, and then he purchased the tractor as part of the property management for that building. And he then acquired other real estate and ended up with kind of a property portfolio to manage. And now he had a justification to deduct this $65,000 tractor that he wanted to buy. And so rather than the tractor being an after-tax expense that cost him $65,000, it was a pre-tax expense, which net of the tax benefit really only cost him, about $50,000. So that $15,000 tax incentive was enough to justify some of the hassle for him to set things up and make sure that he had dotted his I's and crossed his T's to be able to justify this purchase as ordinary and necessary. And again, that won't always be the case, but I'm asked all the time if there's like a list of deductions, and we do actually have a list, but it's really only meant to kind of get the juices flowing. The question to think about is like, where do you spend your money? What are the biggest categories of after-tax money that you're spending right now? And then that's where we start asking the questions. How would I deduct my house, my personal house? And again, there are ways to do that. I don't want to go into each and every little way, but we can get to that in questions at the end if you guys would like. Okay, so let's see. Just checking in on some of the questions here. Let's see, matrix examples. Um, Bob, I'd be happy to do that and provide some of those examples at the end when I get into the questions. So yes, that's a good question. We can just hang on to that. Okay, so we've talked about the need to be proactive. We've talked about entity structures, and we have talked about deductions. And I haven't really gotten into credits a lot, but it's in the same kind of category generally as deductions. It's planning proactively and seeing, what things we might be doing that could be incentivized with credits. And then the last category, broadly speaking, is investments. And what we really are trying to do, so back to this concept of the tax code really is there to incentivize um, business owners and investors for certain economic activities. And what we're trying to do is to live above the line. We're trying to shift the way that income normally flows is we have our income and then we pay taxes. And then with whatever's left, we have our expenses that come out, and then what's left after that is for saving and investing. And generally speaking, like the averages in the United States are right around 5 to 7% of our income is left over for saving and investing. And what we're trying to do is to flip that and to shift as much as we can of the expenses up from after tax. Well, sorry, excuse me, not just expenses and investments from after tax to be able to define them in a way that's pre-tax. And there are, frankly, probably too many ways or too many investments that have those kinds of incentives to go into one at a time. But I will just kind of, again, name a few to whet your appetite and kind of get you thinking. So a very, very common one, probably the most common one, is real estate and investing in real estate and then finding a way to access those real estate. The tricky thing with real estate is that it's passive, and passive losses are usually walled off and not able to be taken against ordinary income. So then we have to have, again, the question is not if, but how. How can we arrange things to either shift some income to be able to redefine it over into the passive category so that we can wash out real estate losses? Or how do we define those real estate losses in a way that brings them over to ordinary? Or do we use something like a C corporation where it doesn't have those different silos, and then we don't have to worry about it? But there's always a way if we're motivated enough. Another investment, so other investments that have real tax incentives are probably the first thing people should be thinking about if for entrepreneurs is the enterprise value of your business, and looking at the business as an asset, whether that is because you are looking to sell it, or whether it's just an asset that you can turn into something that has an annuity of cash flows that may be passive or at least semi-passive. But your business is probably your number one asset. Then real estate, then looking at, there are a bunch of other investments that you have to be careful with and make sure you're, working through reputable companies, because there are lots of, let's say, gimmicky types of investments there. But there are lots of incentives around oil and gas investments, alternative energy like solar and wind, although some of those are being phased out. Um, and um, and I mean, there are lots of industry incentives, including things like film and the arts. There are tons of incentives. So the questions are like, where do you want to put money? And generally speaking, again, back to that triangle at the beginning, what we're aiming for is we're trying to have um, plenty of money, like ample money and liquid money. We're trying to have control over our time. We're trying to have control over our investments. And the sort of typical path is for employees who work at a job and then invest into a 401k, and they can build financial freedom. They can, at retirement, have control over their time. But investing into public equities generally, is going to be very difficult to control, to like roll up your sleeves and get into directly, to get to work if the investment's not working the way that you want it to. Now, there are definitely professional investors for whom that's not the case, but for most of us, this is a passive item that we don't have control over. And that's why that the timeline for financial freedom, for wealth, generally takes 30 to 40 years for W-2 employees. Whereas an employee who's also investing can speed up that timeline significantly if they're, say, investing actively in something like real estate. And they can get to a point where they have control over their investments. And then business owners who are investors, almost universally, business owners that I've seen who are in the most ordinary of industries, plumbers, uh, janitorial companies, um, uh, painters. I mean, like very ordinary. These aren't people who are inventing a new software. If their focus is on the enterprise value of their company, and they're planning strategically, they're able to achieve that financial freedom within 10 years, almost universally. So um, let's see. That is effectively the framework that we use for tax planning. Again, everything is proactive. We need to understand where you're going to be at if we don't change anything. And then say, okay, well, what don't we like, or what do we know is coming? We know maybe you're going to buy another business next year, or you're going to buy a piece of real estate. And so we need to be prepared to have um, we need to be prepared for a mortgage application and understand that the tax return needs to meet some of those other criteria. And then within that, what can we do and how do we set it up? And then these are kind of our general levers that we can pull. And then, of course, again, there are a bunch of sub levers within that. But that is effectively the framework for tax planning. So let's see. Let me just finish up the last few things here. Ultimately, not everybody needs tax planning. If you are, but I always tell new business owners who are just getting started, if you're say under, especially 100,000 in sales, the first thing to focus on is getting your business running and profitable. So open an LLC, just have that LLC open and run the business through the LLC. Everything else can pretty much be done later. Once you cross that $100,000 in revenue and you have like a real kind of kernel of a business going, then we need to start with some very basic tax planning. But at that point, it still doesn't need to be anything super complicated. Generally speaking, most of our clients are business owners who have crossed that seven-figure mark and who are earning over $1 million in revenue at least per year, and then looking for predictability. At a lot of times, the biggest challenge with taxes is not even that that a business owner is overpaying in taxes, is that they don't know what's coming, and so you're just kind of sitting there cringing and hoping that it's that it's not a $50,000 tax bill, but you don't really know until it's like a gender reveal for a baby where your CPA just says, all right, it's this much money, and that's not obviously the way to do it. um, so yeah, if you're feeling frustrated with a CPA who's kind of reacting and who's just looking at what happened and trying to put numbers in boxes. And then finally, if you're not sure what questions to ask, if you're in that like I don't know what I don't know camp, and wondering if it seems like everybody else maybe has some secret that you don't have. If that's the case, then what I would encourage you to do is to reach out and just schedule a consultation with my team. We'll find out if we're a good fit to work with you or not. To do tax strategy right, again, requires that we be proactive and requires really understanding kind of your circumstances. And so rather than offer kind of a blanket solution to everybody, I would say if you think that this is something that you might benefit from, then I would encourage you to schedule a consultation with our team, and we'll be able to help you out and either let you know if we can help you, or potentially even refer you to another CPA. We know several CPAs um, who might be able to help you if you're maybe not quite ready to work with our team. But I think that is what I wanted to say. We still have about 20 minutes left, so I would love to get in and answer some questions. let's
Hey,
do
great job,
this.
Brian. Just wanted to chime in here real fast, if you don't mind.
Yeah, please.
Thank you so much. I love the application. My favorite part was, and I love this, ask how, not if. And a lot of people say, well, there's no way I can do my home office deduction. That triggers an audit. Well, that's the wrong way to think, guys. You don't want to think about that all the time, right, guys? You don't want to be afraid to do things. You want every time you do any tax deduction, especially working with someone like Brian and his team, they're going to look at it from the tax code. That's what they're going to do. And so a lot of times everyone's afraid because they feel like that'll just increase my audit risk. Well, you know what? A lot of times we have entrepreneurs that they do get audited. It's not anything really to be afraid of. A lot of them they expect it every year. I'll have a lot of real estate investors we work with. I don't know about you, Brian. You may have experience. Of course you do. But it's funny. Oh, great. They audited this and said, okay, well, I guess I have to take $100 back. Darn it. Well, that means everything else you took is good. And that happens a lot. So it's not really something to be afraid of. The worst part a lot of times, Brian, is they can say no. That's it, right? It's not that big a deal.
That's 100% right. So anything that we do, we want to make sure that we have a justification for it. That's, and different entrepreneurs have different appetite risks, but generally speaking, we're trying to make sure, can we justify this with a straight face? And that doesn't mean that we would necessarily win if audited. But that's at that point, that's in that gray area where we're having conversations with clients, say, hey, this is where we're at. Like, we can do this, we can justify it. Doesn't mean we would win it if you were audited, but what do you want to do? And if, again, it's like, is this what do you stand to gain? Is it $100 or is it $100,000? And the worst thing that happens is, like, they say no, and then you're kind of
And
back
you
where you
get
started.
70,000. I mean, so
Yeah.
that's pretty typical. Most investors, once you're down the road a little bit, it's pretty common. It's just the name of the game, and you have to remember that tax planning is a game, and you got to play by the rules. So I love it, Brian. And by the way, guys, I did put a link in the chat that is clickable, protectwealth.com/roadmap. If you want a free consultation with Brian and his team, click that link. I love that, Brian. What happens when they click that link? They'll schedule a call on your calendar. Looks like, right?
Yeah, they're gonna end up scheduling with someone on our team, and we'll have kind of a very quick introduction call just to learn a little bit more about you, and you can learn a little bit more about us, and then decide if it makes sense to get more involved from there and schedule like a full hour-long consultation.
And a lot of people are always like, "Well, I don't want to offend my brother-in-law accountant. How dare I do that?" Right? My accountant I've had for 30 years. Well, if you're not getting the deductions you want, that's money in your pocket you're missing. So it never hurts to have that second opinion, at least.
Yeah. I we work with clients who stick with the guy who's preparing their returns. More often than not, it makes sense if you're going to have someone do the strategy, the guy who's preparing the returns probably is not going to be super open-minded to it. But we do that, and the strategy really is a separate thing from the prep. And I would just say, in general, speaking as someone who used to operate this way, I think most CPAs are just they're just swamped preparing tax returns, and they're like, the kinds of questions that you guys as entrepreneurs are thinking about are more of a nuisance to them, and that's why they so often say no. It's because they just like they they've got 50 other tax returns waiting to get prepared. Now you've got this question about this thing, and it's going to take them two
Yeah.
hours to like research it and look at it. And they're just like, it's too risky. So, that what you read as too risky is on the back end. I don't want to deal with the hassle of this.
Very good insight. I love that. That is absolutely true. Most accountants are too conservative to do a lot of things out of the box. So I love that. That's why we have people like Brian. So anyway, Brian, I'll let you jump in if you want to. Can you see the questions okay? You want to jump on those?
Yeah. Yeah.
Okay.
Okay. So let's see. Bob said, can you provide a matrix containing examples of active income losses and passive income losses? Shows which ones offset the others. Bob, I don't have an exact matrix for that. I think probably what makes the most sense is to go back to the entity structure. Let's see if I can figure out the right screen to share.
Yeah, that's great. I love your how you laid that out. The
Yeah.
structure, comes first, and then the strategy. I love that.
Okay, so in general, it's like the most common things, Bob, are that whatever we have that flows through on the passive side gets separated from things that flow through on the ordinary side. Um, there are other categories like capital gains and capital losses, um, but most well, those are probably the main ones. Um, I think in general, if we're talking about why losses get limited, it ends up being for, one, um, it's in kind of a category that doesn't have income within the same category. And then two, it would be because you don't have basis. So someone will start a business, they maybe are the sweat equity partner, not the capital partner, and the business has losses in the first year or two, but they haven't put any cash in. And so they don't have enough basis in the company to be able to take a loss. So they have to bank it and roll it forward. I hope that that helps a little bit, but I don't have a clean matrix. This would be the closest thing. If um, let's see, you have a follow-up question here, Bob. Let me see if that is clarifying. Some tax advisor firms advertise there are 3,000 deductions possible. Being strictly a passive investor in real estate and minimally in the stock market, approximately how many of these deductions might be available to me? Um, so Bob, you're wondering how many of all of these deductions might be available to you as a passive investor in real estate and minimally in the stock market. The answer is 3,000, or it's effectively all of them. Again, if we wanted to badly enough, we could justify a way to make most of those things ordinary and necessary. The challenge you would run into is that all of your income is flowing up through this one side, or sorry, all of your income, and therefore all of your deductions are flowing through this side, and you probably have plenty of deductions. I would guess, just because like if you're invested in real estate, you probably have a lot of deductions. That the thing you're running into is that maybe this is $200,000 negative. Um, you might be theoretically eligible for more deductions, but if that's negative 200 or negative 300, if you can't flow it in to offset your other income, it's not doing you much good. And so the real problem to work on and address is the passive income categorization tied to that real estate. And I don't know, again, specifically for your scenario, what the solution is for that. Again, I've mentioned a few of them, but it probably is not a C corp because you don't have business income to funnel into that same C corp. It could potentially be to look at making some of those rentals into short-term rentals so that we can treat it as an ordinary business activity. It could potentially be to, if you're married and you have a spouse, or depending on what your situation is, maybe you would qualify as a real estate professional. That can be a little tricky, so you've got to be careful about how you do that. But a real estate professional is not the same thing as a real estate agent. It is a set of criteria that you can meet based on your participation and like how much of your income is associated with real estate. And so like that might be something to consider. And if you're again, the battle you are fighting primarily, Bob, is not a question of like more deductions. Probably it is getting these losses out of the silo that they're in to where you can offset it against other income, and then once you clear that hurdle, then you can have the conversation about how do I maximize these deductions.
Great
Okay, let's
answer.
see. Jeff asked, are profits from buying and selling stock options capital gains? I think they are, but if they're held less than a year, said profit is short-term capital gains. You got it, Jeff. That's it. I couldn't have said it better myself. They are generally going to be capital gains. There is a way. Um, well, I want no. I mean, they are going to be capital gains, and then they're short-term. And that is the tough thing. So then you got to again look at look at the silo effect. And one thing that you could potentially do, if that is kind of an active business for you, it's not going to change the underlying nature of those equities as capital gains or losses, but you could potentially set it up as a operating business to be able to take some expenses against against that income as investment expenses. And so if you set the expenses up right, you can take the expenses, even though not as business expenses, but as investment expenses to reduce those capital gains. Okay.
And by the way, the next question there is yes, the meeting is recorded. We do put this, guys, on our YouTube channel. That will be sent out to all registrants tomorrow automatically. Just stay tuned. Usually it's 24 hours afterwards once Zoom records it and we have it edited, compressed, and loaded. So it just takes some time, guys. But yes, it will be sent tomorrow.
Right. In regards to how do our fees work, those are somewhat dependent on circumstances because the engagements kind of vary on scope. But generally speaking, the sort of the way in, the very first little baby engagement that we do is something we call a tax roadmap, which is effectively a plotting out of saying, okay, if you don't change anything, what are your taxes going to look like for this year? And then what are the things in each of those pillars? What could we do with your entity structures to improve how that income is taxed? What could we do to arrange your circumstances to make more of your expenses ordinary and necessary to be able to deduct them? And then what might you be able to do with investments to lower your taxes? And so that tax roadmap, we charge $2,500 for. But again, like not that doesn't even make sense for everybody. And for the people who it does make sense for, that's kind of a step in to start working with us. And generally speaking, our clients are long-term clients. So they would graduate from something like that into a long-term ongoing planning and tax engagement. Okay. Please comment on the tax implications for people who have started to receive Social Security benefits. Well, one, we don't deal with a lot of Social Security because our main clients are entrepreneurs who are still kind of in the, in their earning years, not yet into retirement. However, my observations from clients who have gone into that point and have started taking Social Security benefits are the the key is to try and take as little other income as possible so that you're not getting your Social Security benefits up to the point where they become taxable, which is hard to do. And it's hard to do again once you're already there. For the clients who we're helping plan right now, we don't really recommend much in the way of like traditional retirement accounts for that reason. Because what my observation has been from the clients that we work with is that this theoretical income cliff that people are going to drop off at retirement never actually happens. They have other investments and other income coming in, and now you've got Social Security benefits that come in, and then there's just no way to make those Social Security benefits anything but taxable. And so now they're getting added on top of, you've already got income, and so now your Social Security benefits get stacked at the top of that as far as tax rates go, and are being, taxed at, let's say in the 30s in percentage, and it's just kind of painful and frustrating. And I don't have a good solution for it except way in advance, the setting up of retirement accounts and really favoring Roth accounts and then favoring other investments that we have more flexibility on. How do we manage the deductions associated with them so that we can have investments grow without being forced into recognizing taxable income? But that's kind of a long-term planning discussion. Okay, and then Scott asked, do we have a few examples of investments you can make in your own service type of business? How to invest excess revenue that's sitting in an S corp? Okay, great question, Scott. Really, I think that's a question with almost an infinite number of answers. But the way to think about that is, what could you do to grow the enterprise value of a service type business? That might be as simple as you have capacity and you need advertising. It might be, um, depending on the service type business, maybe it's not equipment as often, but it might be equipment. It might be a an investment into software that would help streamline your business. It might be investment into a key employee, things that we don't think of as investments. Well, we don't often think of as investments because we think of them as operating expenses. But the investment piece comes in the fact that we are reducing taxable income in a way that will increase the asset value, the enterprise value of the company. And the other reason we don't often think about those things is because we don't think about financing for in the operations of a normal, business. We think, okay, we brought in 1.5 million, and then we had 1 million in expenses, and so we have $500,000 left. And maybe you have other things you want to do with that 500,000. And so we're like, well, I don't want to have to put a dollar in, but we don't think about like financing in the business sense in the same way that we would say for a piece of real estate. But there might be a situation where it makes sense to go get a loan to be able to finance an investment like that into a business that will then reduce the taxable profit, and mean that rather than having 500,000 in income, you have 200 or 300,000 because you've made this long-term investment that you used financing to pay for in the same way you would for, say, real estate. It's just a little less tangible oftentimes within a business. But those are the, if you just think about your business as an asset, what are the areas that you could invest in that business to increase the asset value? And again, that can mean size, that can mean profitability, and that could also mean in how you as the owner relate to that business. And in like if you can do something to remove yourself from the day-to-day operations, then you turn that business into more of a passive cash flow annuity that then increases the value.
See, Brian, I'll pipe in on that one a little bit. I love that because you can tell, obviously, you have a lot of experience with high net worth clients and business owners that have done this very thing many times. A lot of times we Don and I say, in several of our businesses, the goal is to show zero income at the end of the year. And everyone says, well, that's weird. You don't want to make any money? That's not at all what we want to do. The business doesn't show any income, but we do, and so I love that. But I love that, Scott. That's a great question. And clearly, Brian's worked with that. Don and I have tried to do that a lot too, is make things more passive in our business. And I think that's a fantastic way to go. Very cool. Love that answer.
Awesome. Thanks, Kendall. All right. And Faith Marie asks, is it ever okay to add new businesses to an existing LLC to show length of time in existence? Okay. I have an LLC with my DBA notary business, but planning to acquire assistant living facility, but wants to keep the length open further than create a new LLC. What are your thoughts? I would say, Faith, in general, that would be the ideal scenario to create a sub LLC. And I think if I understand what you're asking correctly, that is kind of you have like you can take the best of both worlds because you have your existing business, and let's see if I can get this to work. You have your existing business, and then what you would do is you would create a wholly owned subsidiary LLC, and that wholly owned subsidiary. So an LLC is just a legal entity. I like to think of it as like just a bucket. So it's sitting there, and like that bucket, if I form an LLC, I've got the bucket. I can put money in that bucket. I can take it out of the bucket. It's different. It's not my pockets. It's not in my wallet. It's over here. And so legally, it's in a separate container. But by default, an LLC is a disregarded entity if it only has one owner. So um, so when the owner is an individual, then you would file that as just self-employment income on your personal tax return, even though it's in a separate legal entity. For a business, if your LLC is owned um, by another LLC, by an S corp, then it's a disregarded entity of that LLC, and so you'd still only have to file one single tax return, and you get all the benefits of the S corp, and everything just funnels up and goes on the same tax return. So you keep things simple that way, but you have still the legal protections of having things in the assisted living facility going into and coming out of this separate bucket, legally speaking. It's just that the IRS kind of has both of those buckets sitting inside one circle, and it says for tax purposes, just put it all together and file it all together. So you kind of get the best of both worlds by doing it that way, and that is uh, without understanding all the nuance of your situation, like general principles. That's exactly how I would do it. I would have one primary S corp, and then that's it. And other entities, whether you're being a partner in another business with someone else, or whether you're just owning another business that you still want to own completely, just have your ownership funnel through that single LLC that's filing as an S corp. Okay, probably the last one here. We have tech startups often have investors that tech startups often have investors that tend to prefer a Delaware C corp. Oh, okay, with a clear cap table. Yep. So they can invest in or buy a safe preferred instrument. Okay. From a tech startups, there is really no option, correct? Or can that startup start as an LLC first, then convert over when ready to take on investors? That's a great question. Um, Generally speaking, one, it's kind of a pain to switch over. So most businesses are it makes sense to start them up as an LLC because again, it's just a bucket, right? And then you can slap whatever label you want on the front of that bucket. You can say this bucket, this LLC is going to be taxed as a C corp. This bucket's going to be taxed as a partnership. Sorry, I meant to say S corp first. That's the most common. This LLC is going to be taxed as an S corp. But you can also say this LLC is going to be taxed as a C corp. It doesn't have to start as a corporation to do that. However, like in your circumstances, I probably would, knowing like if you're having a tech startup and you want to form it as like that you're going to be seeking investors, I would set it up that way from day one. I don't personally think Delaware C corps are all they're made out to be. I think there are other states that have better advantages, Wyoming and Nevada, and I don't know that investors would really care about this state. I think the Delaware thing is more about just kind of a sheep mentality. That's the way that it used to be. But and it almost doesn't matter if you know that investors are going to want to see Delaware, then like that's what you're aiming for. And from a tax perspective, the IRS doesn't care what state it's formed in. But I would probably start it as a C corp from day one, and then that's where to begin with, you're not gonna have to worry about any of this. But as you start to make profits in there, you're probably going to want to have an S corp separately. Now, that you don't need the C corp to be owned by the S corp. You would own the C corp. But rather than just increase your wages from the C corp or do the double tax thing and take dividends from the C corp, what you probably would want to do is at some point when you're ready to start taking profits out of the C corp, set up an LLC that you own 100% of, that C corp can pay management fees to, and that way you don't have to, if you're making a couple $100,000 in as like the CEO of that tech startup, you don't have to take all of that in wages and get absolutely hosed on taxes. You can funnel that through as management fees through your LLC, which is an S corp, and take all the benefits of that and have sort of a staging ground for that income where it flows first to the LLC. That's where you can um, shift it over and call it business income and make it eligible for the QBI deduction. That's where you can take things like home office deductions or deduct a vehicle, setting it up proactively, of course, to make sure that it's all documented. And you can, turn that $300,000 of income into maybe $200,000 of taxable income that passes up to you. So it's kind of a long answer, but I would start it as a C Corp and then just keep in mind that as your income grows from that, you're going to want it to be business income. And so you're still probably at some point going to want an S Corp that you control.
Yeah, we agree. We work with Anderson Advisors. They typically agree. It used to not be the case. Oh no, double taxation. We can't use a C corp. Well, there's a lot more reasons to use them nowadays than there ever used to be, for sure. So, especially for a business you're starting up and you eventually want to sell, you want different perks. C corp's the way to go, and it doesn't have to be Delaware, for sure. I agree. Wyoming's great. Nevada's great, and a lot less expensive and less headaches. So a lot better opportunities. Brian, if you don't mind, go back to your last slide again, just so they can see the link to go to. I did put that back in the chat screen. Again, it's protectwealth.com /roadmap for a free consultation. I love it. We really do recommend it more than anything. Don and I especially love when we have someone like Brian who comes on, and you can tell he's worked with entrepreneurs, investors. He has clear experience helping you save money. So he's not just theory. He knows exactly what to do because he's doing it consistently. And again, that is true. Dr. Danko comes in our events and he says, what is the way that by far, statistically speaking, what separates millionaires from those who are not? It is those who spend more time planning with taxes than anything else, because that long-term saves you money. And so someone like Brian and his team, we do strongly suggest you do that because it's a free consultation. If it works, great. If it doesn't, great. It's a win-win for everybody because at least you know, and I'm sure Brian and his team can give you some good pointers, and maybe down the road it might work better for you. Anything else I missed in there, Brian?
No, I think you got it all. Thanks.
Okay. Well, I know we couldn't get to all the questions, guys, but I just wanted to thank you, Brian, again, and Justin, again, for your team for taking the time to do the webinar with us tonight and introducing some cool strategies and ways of thinking. I really love it. Thank you so much for your time tonight.
Thank you.
We appreciate it. Everybody else, thanks for being on tonight. Hope if we don't see you before the year end, Happy New Year, Merry Christmas, everybody, to you and your loved ones. Hope it's a great one. We have a lot of good things coming up in 2026. It's going to be an exciting one. So reach out to Brian and his team. Get your taxes done, planning before year end. I strongly suggest it. You're going to be busy, Brian.
Yeah. All right.
Everybody, thanks, time. Have a great night.
Take care. Bye.
Take care.